Today, I have found a dividend stock with a yield over 10%. So is it an opportunity to buy, or is it a serious red flag? This stock has seen strong growth, with revenue up 224%, earnings up 178%, and free cash flow up 181% in the last 4 years. However, it's odd that a stock with such a strong growth rate has a very high dividend yield. So why might this be? It's likely that this stock has a low valuation. When we look at the PE ratio, we can see that this stock is trading at 3.5 times 2022 earnings, which is closer to the 52-week low and 1/3 of the UK market average. However, this stock averaged a PE ratio of 12.8 times in the last 5 years and 7.9 times in the last 10 years. We can therefore infer that this stock appears quite cheap. In fact, we have also seen a decrease in the premium that investors have placed on the book value, with a current price to book ratio of 1.5 times. This is closer to the 52-week low and below the 5-year average of 2 times. However, it does also align with the 10-year average, suggesting that in the last 5 years, this stock has devalued, or it has seen a large increase in the net book value. So why are investors avoiding this stock, and is it a value trap? Notably, the return on capital employed has improved drastically in the last few years. The 2022 figure is impacted for reasons I'll discuss later, but in 2021 it was 29.5%, which is well above the 10-year average of 11.2%. That said, there has been an increase in the estimated number of total shares. In the last 4 years, this has increased by 2.6%. However, it's likely much closer to 30% in 2023, as a large-scale acquisition took place in which some shares were used as part of the deal. Despite this, we can see that the earnings per share growth up until 2022 was still strong, up 170%. The dividend per share figure has also seen a very high growth trend, with it rising as much as 390% in the last year, and this has pushed the dividend yield up from 2.5% in 2020 to 10.4% today. So what is the catch with this high yield dividend stock? Well, we can infer that such a high dividend yield means that investors may be wary of future dividend cuts or suspensions. However, when we look at the payout ratio of 27.4%, this is very low and suggests a very sustainable dividend, meaning the company can reinvest a majority of the earnings back into the business. But for a dividend yield to be this high, investors are concerned about these two things: future earnings and debt. So is this stock extremely risky with loads of debt? Well, no, the balance sheet is of a good quality. In fact, as of 2022, there's zero debt. In the last 4 years, they've had an increase of equity of 107% and a 362% increase in cash at the same time. This has pushed up the net book value by 186% to £823 million, which is actually greater than the market capitalization in 2022. The current and quick ratios are above 2 times, indicating financial agility with the ability to navigate volatility in the possibility of an affordability crisis, MC Oz. Okay, but what about future earnings? Can this company continue its high growth? As of the first half of 2023, revenue has experienced significant growth in the last 2 years of nearly 240%. But on a 1-year basis, it appears to have fallen by 4%. That said, in this same time frame, profits have increased by 50%, which appears to have pushed up the profit margin for the half to 51.5%. Although this stock has actually broken its zero debt streak, adding £210 million of debt to the balance sheet, but when compared to the growth of equity and stable levels of cash in the last year, it's meant that the net book value has actually increased overall by 18% in this time. But why has the stock suddenly taken on so much debt? Is it now a risky investment? Well, at the end of 2022, this business made an acquisition to diversify production. The new merged company is more balanced by output, but still remains to have a very high geographical exposure to the UK. The acquisition was large and represented a total cost of £297 million, and this has brought along a drawn debt facility of £330 $140 million. This acquisition has had an impact on the profit figures in the first half of the year, as it includes a one-off non-cash accounting entry, meaning the profit figures look more attractive than they actually are. In fact, the revenue figure, excluding the acquisition impact, would actually be £241 million, suggesting a fall of 32% from last year. However, this is due to changes in commodity prices and naturally would be volatile. Based on a discounted cash flow valuation, I think shares could be worth around £4.33 each. However, due to the nature of the industry, with it being extremely cyclical, therefore leading to fluctuations in earnings and revenue, a discounted cash flow model is unreliable. So I will not be buying any shares of Serica Energy and instead would look towards an energy ETF. Maybe you're concerned that this stock is just too risky for you. Do I know of another stock that's more defensive? Well, yeah, click here to learn about a stock with an impenetrable moat.